In part 3 of Indian Agriculture Facts and Figures chapter, let us look at the sources of agriculture finance. Before having a look at organized and unorganized sources of agriculture finance, let us briefly try to know why do agriculture finance is required, what is basically the need for the same, and what term loans that agriculturists basically are looking for. Now, finance for production can be divided into short-term loans, which are for a period up to 15 months, medium term, which is up to 5 years, and long-term loans, which are above 5 years. Short-term loans are needed for purchasing seeds, manure, fertilizers, or for meeting labor charges, etc. These are expected to be repaid after the harvest. Medium-term loans are granted for purposes such as sinking of wells, purchase of bullocks, pumping plants, and other improved implements. Loan repayable over a long period of time, that is above 5 years, are classified as long-term loans. These are utilized for payment of old loans, purchase of heavier machines, making permanent improvements, and increasing the size of holdings. Let's go ahead and look at the organized or institutional sources of agriculture finance. Now, what do we mean by organized sources? It refers to those institutions which come under the regulation or policy network of RBI. Since 1934, RBI has always shown interest in providing and expanding rural credit. The establishment of NABARD was done with the same purpose in 1982. RBI, under its policy regulation, has directed all the banks except the foreign banks to channelize 40% of the net bank credit to priority sector, of which at least 18% has to flow to agriculture sector. In case there is a shortfall in meeting this target, then the difference should go to the Corpus Rural Infrastructure Development Fund. The first source of organized finance for the agriculture sector is National Bank for Agriculture and Rural Development, that's NABARD. It's an apex development bank which was set up with the intention of facilitating credit flow for promoting agriculture, small scale industries, cottage and village industries, including handicrafts and other village crafts. NABARD performs few of the key functions which include: first, providing refinancing to lending institutions in rural areas, which means NABARD does not provide loans directly to the individual and business, but loans needed by individual and business for agriculture and rural development project is provided by commercial banks, regional rural banks, cooperative banks, non-banking financial corporations working in rural areas. NABARD in turn functions as the refinancing institution and sanctions some percentage of the total loan, which can vary between 50% to 95%. Now, what are the criteria for refinancing under NABARD? First one, technical feasibility of the project and adequate response from the prospective beneficiaries. Second one, financial viability and adequate incremental income to ultimate borrower to repay a loan within a reasonable period. And the third one is organizational capability to ensure close supervision. In addition to this, NABARD acts as a coordinator in operations and functioning of all rural credit institutions, which include commercial banks, RRBs, land development banks, and also it offers training and research facilities to these institutions. It provides direct loan to state government to contribute towards the share capital of cooperative credit institutions. The next source of finance here is commercial banks. Unlike NABARD, commercial bank provides direct credit to farmers or rural artisans. It provides short-term as well as long-term loans. Loans are sanctioned to purchase agriculture equipments, construction of wells. Support is also provided to take up dairy or poultry farming. As an indirect financer, they provide loans to cooperative societies to help them provide production credit to farmers. It finances the operation of Food Corporation of India, the state government and other agencies involved in procurement, storage and distribution of food grains. Commercial banks do encounter problem of large number of willful defaulters in rural areas, thus increasing their non-performing assets. There are many times lack of coordination between commercial banks in rural areas and also between them and other cooperative credit institutions. The third source of organized finance is regional rural banks. On the basis of recommendation of Narasimha Committee, the government formed regional rural banks in 1975 mainly to cater the credit needs of small and marginal farmers, agricultural laborers, artisans, small entrepreneurs and to help them develop agriculture, trade, commerce, industry and other productive activities in the rural areas. The issued capital of RRB is shared by the central government, sponsor bank which is usually a commercial bank and the state government in the proportion of 50%, 35% and 15% respectively. The main objective of RRB was to close the credit gap in rural areas, to ensure that rural deposits do not outflow to urban areas. It also aimed at reducing the regional imbalance between urban and rural areas by increasing employment opportunities in rural areas. The commercial bank, which is also a sponsor bank for RRB, mainly provides for managerial and financial assistance and helps them borrow at a lower rates of interest. The RBI gives concession in terms of lower cash reserve ratio and statutory liquidity ratio, whereas NABARD lays down policy for its functioning and also oversees the operations of RRB. The fourth institution of finance is credit cooperative societies. Cooperative credit institutions are broadly divided into urban and rural credit cooperatives. Rural credit cooperatives are further classified into short-term and long-term credit cooperatives. The short-term rural cooperative societies have a pyramid-shaped structure. Its primary agriculture credit societies are at village level, which directly lend to individual borrowers. At district level, it is district central cooperative banks, which function as a link between primary agriculture credit societies and state cooperative banks. Long-term cooperative credit structure is further classified into primary cooperative agriculture and rural development banks at primary level and state cooperative and rural development banks at state level. Long-term rural credit is usually provided for activities like minor irrigation, cultivation of horticulture and plantation crops, poultry farming, dairy activities, purchase of agriculture machinery like tractors, power tillers, etc. Basically, activities which require huge investment and longer repayment period. They also provide loans to small-scale industries, power looms, rural housings, rural hospitals under non-farm sector schemes. Primary agriculture credit societies helps to raise capital for giving loans to individual members. It inculcates the saving habit among rural people by collecting deposits, supplies agriculture inputs and services at remunerative prices. It helps to provide for irrigation facilities on land owned by farmer members. As agriculture is a seasonal business, it also helps and encourages members to take up other activities like animal husbandry, poultry farming, horticulture, beekeeping, etc. The district central cooperative banks, as said earlier, basically are support providers to PACs, and they lend to PACs and not to individual members directly. There also exists inter-district central cooperative banks transfers in case there exists a shortage in one and surplus in another district central cooperative banks. The state cooperative banks are apex institutes in the cooperative credit structure of the country. They are linked between NABARD and lower level of credit institution. The last in this category is microfinancing. As the name suggests, it refers to small loans and small savings, basically aimed at encouraging entrepreneurship among poor people who usually lack collateral security, steady employment, and verifiable credit history, and hence do not qualify for loans from commercial banks or cooperative credit institutes. It's been a great source of financial help to rural people. Most of the time, these credits are given to self-help groups comprising of women entrepreneurs, thus ensuring women empowerment. NABARD has been quite active in facilitating the growth of microfinance institutes. It provides for training and capacity building, building of partners, promotional grant to institutions, and promoting the self-help groups. Next, let us try to have a look at unorganized or non-institutional sources of credit which have been in existence even prior to independence. The first one being moneylenders. Most dominant and oldest source of credit to people in rural areas. In 1950s, it accounted for more than 70% of rural credit in India. Even today, in spite of growth of organized financial institutes in rural areas, moneylender is still seen as an option for provision of credit by people in villages. There are two types of moneylenders. One, agriculture moneylender, who combines farming with money lending jobs. Basically, they are the rich farmers. And two, professional moneylenders. They are only businesses money lending. They usually charge high rate of interest, but the ease of getting credit and lack of organized credit in every part of India till date has allowed money lenders to flourish even after 70 years of independence. The second source in this category is Indigenous Bankers. It's like non-official bank or one that is not regulated by RBI. Just like bank, they accept deposit and give loans. They even deal in short-term credit instruments like bill of exchange, which is termed as hundis. It helps in financing and redistributing of agriculture goods and services. They lend to limited number of clients and usually prefer lending larger amounts compared to money lenders who lends even very small amount of for consumption needs. The interest rates on loans vary on the basis of type of loan, duration, security provided. The interest charge is lower than that of moneylender but is quite higher compared to commercial banks. The third source is traders and commission agents. These people grant loan to farmers for productive purposes against the crop without completing any legal formalities. But unfortunately, they compel the farmers to buy inputs and supply output to them. They charge high interest on loans plus commission on every purchase and sales. Fourth one are landlords. Landowners, to be precise. They give loans to small farmers or their tenants for production or even meeting their day-to-day needs. They are small source of finance, but in rural areas for poor people, they still are one of the important source of finance. Fifth one is relatives and friends. Basically, they are own family and friends. They are relatively soft loans compared to maybe moneylenders or indigenous bankers or traders. But as we all know, a poor farmer in India will not have rich family or friends, and hence it makes up for small amounts, but in times of need every rupee counts. Now let's have a look at why do unorganized sector as a source of finance in agriculture still exist as of today. What is the significance of this unorganized sector or non-institutional credit in Indian agriculture? The basic advantages are flexible terms and conditions, no formalities, paperwork or procedural delays as in case of commercial bank or any other organized institutes. They grant for productive and consumption purpose. Unlike bank, they operate usually 24 by 7 and 365 days as they stay in the same village. Just to ensure regular flow of income to them, they don't insist on repayment of principal amount but just insist on regular flow of interest amount. So if they are so good, basically let's also try to know what are the defects and why does RBI wants to bring more and more of rural credit under the umbrella of organized sources of finance. The defects of unorganized sources are exorbitant interest which are charged from poor farmers. Usually they exploit the borrowers as no official records are kept. No one ever knows whether loan has been repaid or it has been still not repaid. And because of it, many a times the loan repayment goes on for a long time and even get passed on to next generation. Small and marginal farmers are forced to sell their land at low prices and work as tenants or wage laborers by landlords or even money lenders. Thank you.